Today, we are doing a deep dive into the first real-world operational update for UI Boustead REIT,
which trades under the ticker UIBU. So our objective for you, the listener, is to systematically examine this initial business update from July 2026. Just to establish the parameters of our discussion, we are not offering financial advice.
Yeah, absolutely not. Nor are we taking any political stances on the macroeconomic data we will discuss.
Right. This is a strict, factual review of the material.
I'm going to go to the next slide.
Okay, so we need to detail the external manager setup.
Right. The manager is an entity named UIB REIT Management Pete Ltd.
And this manager is a wholly owned subsidiary of the sponsor,
which is UIB Holdings Limited.
Yes. The documents emphasize the physical and financial scale of the sponsor.
Because as of December 31st, 2025, the sponsor holds approximately 4.0 billion United States dollars in assets under management.
That translates to over 19.0 million square feet of gross floor area located throughout Asia.
To put 19 million square feet into perspective, that is the equivalent of hundreds of large-scale industrial warehouses operating simultaneously for one parent corporation.
Right. And regarding the ownership structure, Boustead Projects Limited holds an approximate 24% stake in UIB Holdings.
And they hold that through an intermediary entity named BP Unity Pete Ltd.
Now, looking at the schedule for potential future asset acquisitions, there is a notable detail.
Yeah, I noticed this. There is no right of first refusal disclosed in the filings.
None at all.
The stated acquisition channels rely on acquiring the stabilized assets of the sponsor and Boustead projects, plus finding properties from outside third parties.
The lack of a right of first refusal is a significant structural detail. In corporate real estate, a right of first refusal is a binding legal contract. It dictates a strict sequential process. If the sponsor decides to sell one of its existing properties, the contract forces the sponsor to offer that property to the REIT first,
before negotiating with any outside buyers.
Right. If the REIT management reviews the property and declines the purchase, only then is the sponsor legally permitted to sell the property to a private equity fund or another competitor. If the sponsor completes the construction of a new logistics facility and secures a tenant, they could choose to sell that stabilized asset directly to an external buyer.
Wait, so the REIT management might not even be notified of the sale until it is completed?
That is entirely possible. Therefore, the certainty of the future asset supply is much lower.
Right, because the REIT is relying on the current intentions of the sponsor's executives rather than a legally enforceable mechanism.
Exactly. The documents do mention, however, that the REIT holds specific call options for future acquisitions.
Yeah, they hold a call option for the balance interest in UIB Conan Phase 3 at a 4.0% exit yield.
And they also hold a call option for the remaining 49% of a Seletar aerospace facility,
which can be exercised after the temporary occultation permit is issued.
A call option is a financial contract that gives the REIT the right, but not the legal obligation, to purchase a specific asset at a predetermined price or yield within a specific time frame.
Okay. These options provide targeted acquisition opportunities, but they are limited to those two specific properties.
Right, unlike a right of first refusal, which covers the sponsor's entire portfolio. Now we will examine the fee structure.
Yes. The base fee is set at 0.50% per annum of the deposited property.
And the deposited property is the total financial value of all the physical assets and cash owned by the REIT.
The filings state explicitly that this 0.50% rate is at the absolute maximum limit of the typical industrial S-REIT peer range,
which is typically between 0.30% and 0.50%.
Then there is the performance fee.
Right, this is set at 25.0% of the year-over-year increase in the distribution per unit. Well, let us use a clearer example. If it is 5.0 cents in year 1 and goes up to 5.2 cents in year 2, there is a 0.2 cent increase.
Right, and the manager receives 25.0% of that 0.2 cent increase.
Exactly. If the manager fails to improve operations and the distribution remains at 5.0 cents, or drops to 4.8 cents, the performance fee is exactly zero.
That clarifies the distinction. The base fee rewards the manager for acquiring more properties and increasing the total size of the portfolio,
while the performance fee only rewards the manager if the actual income paid to the investors increases compared to the previous year.
I am going to go to the next slide.
So we are reviewing the first reporting period, financials, and the capital allocation.
Yes, we need to detail the difference between the forecast and the actual results.
For the specific period of March 12th, 2026 to June 30th, 2026, the net property income was 29.2 million Singapore dollars.
And this figure is mathematically 4.3% below the initial public offering forecast.
Right. The gross revenue was 37.2 million Singapore dollars, which is 3.6% below the forecast.
The documents provide explicit reasons for this financial variance. First, the Japanese yen weakened in value against the Singapore dollar.
Second, a lease commencement at the UIB Conan Phase 2 property was delayed.
Meaning the tenant did not move in on the scheduled date, so the rent was not collected during that delay.
Exactly, although the document notes the asset is now 100% occupied.
There was also a positive offset to these negative figures.
Yes. The shared joint venture results was 3.3 million Singapore dollars.
Which is 30.3% above the forecast.
Right. This additional revenue resulted from the Razor AAHQ, located at 6 Tampines Industrial Avenue 5.
Next, we need to analyze the capital allocation during this period. The REIT committed 25.2 million Singapore dollars to fund 2 co-investments.
And they used internal funds and debt facilities to pay for this,
which raised the pro forma leverage from 36.4% to 38.6%.
Let us contrast these 2 specific investments because the numerical returns are very different.
Yes. The first is a 51% interest in a Seletar aerospace facility. This investment yields 8.6% on cost.
And this 8.6% yield exceeds the 2.5% cost of the debt used to acquire it.
It also exceeds the REIT's own overall distribution yield, which is approximately 7.9%.
Right, so that specific transaction is accretive to the portfolio. The REIT borrows money, paying 2.5% interest annually on that borrowed money.
They use the borrowed money to buy the Seletar asset.
Yes. The Seletar asset generates an 8.6% return annually. After paying the 2.5% interest expense, the REIT retains a 6.1% positive margin.
Furthermore, because the 8.6% return is higher than the existing 7.9% average return of the entire portfolio, adding this new income stream mathematically increases the total average yield of the REIT.
Exactly.
Now, the second investment functions differently.
It does. It is a 24.26% interest in UID Conan Phase 3.
And this investment yields 4.8% on cost.
The 4.8% yield is above the 2.5% debt cost, so it still generates a positive margin over the interest expense.
However, the 4.8% yield is below the REIT's existing 7.9% distribution yield.
Right.
I'm going to go to the next slide.
Here we focus on foreign exchange risk mitigation.
We can quantify the exact exposure the REIT has to Japan. The 2 properties located in Japan account for 28.8% of the agreed property value.
However, they generated only 14.4% of the gross revenue during this specific reporting period.
The documents detail a method used to mitigate currency fluctuations, which is a natural hedge.
Yes. Approximately 66% of the Japan portfolio has a natural hedge in place because Japanese yen-denominated debt constitutes 46% of the REIT's total borrowings.
Despite this natural hedge, there is an ongoing risk. The depreciation of the yen is explicitly cited as a primary reason the net property income was 4.3% below the forecast.
In addition, the Bank of Japan cut its fiscal year 2026 economic growth forecast from 1.0% down to 0.5%.
The documents also omit specific information, right? They do not disclose the proportion of the Japan distributions that are hedged with forward contracts.
No, nor do they disclose the length or tenor of those forward contracts. If the yen has depreciated, the exchange rate is less favorable. The exact same amount of yen collected from the tenant will result in fewer Singapore dollars after the conversion.
And this reduction in the converted currency causes a direct numerical reduction in the distribution per unit.
Which is exactly why the earnings missed the forecast.
That makes the missing information regarding forward contracts very important.
It does. A forward contract is an agreement to exchange currency at a locked-in rate on a future date.
So, without knowing what percentage of the income is locked into forward contracts, we cannot calculate the exact exposure the remaining income has to further yen depreciation.
Exactly.
I'm going to go to the next slide.
This section contains property portfolio details, Part 1.
Yes, and for this specific section, we are strictly discussing two properties, Edward Boustead Center and GSK Asia House.
Edward Boustead Center has approximately 17 years remaining on its land lease,
which is scheduled to expire in 2043.
Right, and the building is currently 100% occupied by tenants.
GSK Asia House is categorized under business space. It has approximately 19 years remaining on its land lease, which expires in 2045, and it currently has a 98.1% occupancy rate.
The financial value of a commercial property is calculated based on the future cash flows it can generate. Because the legal right to collect rent ends at year 0, the total number of future cash flows is a finite number.
Right. As each year passes, there's one less year of rent to collect.
Therefore, the financial value of the property mathematically amortizes towards 0 as the expiration date approaches.
I am going to go to the next slide.
This is property portfolio details, Part 2.
In this section, we will review the remaining properties in the portfolio that are flagged for lease decay risk.
Yes, these properties are Rolls-Royce Solutions, Asia, Jabil Circuit, 10 Celatar Aerospace Heights, 11 Celatar Aerospace Link, and 31 Tua's South Avenue 10.
We have the specific lease durations remaining for each location.
Jabil Circuit and 10 Celatar Aerospace Heights both have approximately 16 years remaining on their leases.
Rolls-Royce Solutions Asia and 31 Tua's South Avenue 10 have approximately 17 years remaining.
And 11 Celatar Aerospace Link has approximately 19 years remaining.
We can aggregate these figures to quantify the total lease decay risk across the portfolio.
Right. These specific 7 properties, which includes the 2 properties from our previous section, all have less than 20 years of remaining land lease.
They represent a combined agreed property value of approximately 313.9 million Singapore dollars,
which equates to 16.5% of the total 1,904 million Singapore dollar portfolio value.
That 16.5% figure is a critical metric for evaluating the long-term viability of the portfolio.
It indicates that over 1/6 of the REIT's total asset value is currently allocated to properties that are actively amortizing towards 0.
Without securing extensions on these leases, the total deposited property value of the REIT will continuously decrease as these assets approach year 0.
Which, as we established, also reduces the base fee for the manager and limits the total revenue generation capability of the portfolio.
Right. So if the management team wants to prevent these assets from reaching year 0, they must apply for a lease extension from the state. Yeah. So if the government is prioritizing the aerospace sector, a proposal that includes a confirmed long-term lease with an aerospace manufacturer will have a higher probability of approval.
Right.
I am going to go to the next slide.
We will examine the property market outlook.
Yes, we start by comparing the geographic value split of the entire portfolio.
Singapore represents approximately 71% of the total portfolio value. Japan represents approximately 29% of the total portfolio value.
We have detailed macroeconomic data regarding Japan. Japan's gross domestic product grew 1.8% on an annualized basis in the first quarter of 2026.
This growth was driven by domestic consumption and the export of goods.
However, the Bank of Japan cut its economic growth forecast for the fiscal year 2026, reducing it from 1.0% down to 0.5%.
The explicitly stated reason for this reduction is the risk of inflation arising from the conflict in the Middle East, which impacts energy prices.
Next, we have the industrial property data for Singapore, provided by JTC for the second quarter of 2026.
Right. The All-Industrial Rental Index, which tracks the average rent across all types of industrial properties, increased by 0.5% quarter over quarter.
While the overall average increased, the detailed segment data reveals a specific risk to this REIT.
Yes, the business park space was the only property segment that recorded falling rents during that quarter. Rents in the business park segment decreased by 0.1% quarter over quarter.
We can connect that 0.1% decrease directly to the REIT's revenue because the documents categorize 29.7% of the REIT's total portfolio value as business space.
Exactly. If the rents in that specific segment are decreasing, nearly a third of the portfolio's value is exposed to that negative pricing trend.
The JTC data also mentions supply constraint dynamics. Specifically, it notes that 400,000 square meters of new industrial space are due for completion and will enter the market in the second half of 2026.
Right.
I'm going to go to the next slide.
Now we review tenant profiles and concentration risk. The overall portfolio WALE is 5.4 years. The Singapore properties have a WALE of 4.9 years, and the Japan properties have a WALE of 7.5 years.
The top 10 largest tenants average a WALE of 7.8 years.
Finally, we look at the lease expiry schedule. The data shows that 11.2% of the gross rental income is generated by leases due for renewal in the remainder of the fiscal year 2027.
And the documents note that 78% of this expiring income is currently under advanced negotiation for renewal.
A longer average of 7.8 years for the top 10 tenants indicates that these specific large corporations signed lease contracts with significantly longer durations than the smaller tenants in the portfolio.
Why do large corporations prefer longer lease contracts?
For large space occupiers, the physical logistics of relocating their operations involve massive capital expenditure. A global technology company or an aerospace corporation cannot simply move their equipment over a weekend.
Right. They must physically transport heavy machinery, reconstruct specialized temperature-controlled environments like clean rooms, and establish new supply chain delivery routes at the new location.
The cost of this relocation, combined with the operational downtime where they cannot manufacture their products, is extremely high.
So they use the lease contract to secure their location and avoid those relocation costs.
Correct. To avoid the high financial cost and the operational disruption of frequent relocations, large tenants negotiate longer lease terms, such as 10-year or 15-year contracts.
And the REIT management readily accepts these longer leases because they provide a guaranteed, legally binding stream of income for a long duration, which reduces the risk of the property becoming vacant.
Therefore, the 7.8-year average for the top 10 tenants mathematically increases the stability of the REIT's revenue.
I'm going to go to the next slide.
This section details tenant quality and sector concentration.
Regarding the credit quality of the tenants, 100% of the top 10 tenants are classified as Fortune 500 companies, Fortune 500 Europe companies, or public-listed multinational corporations.
Additionally, 65.9% of the total tenant base operates in high-tech, value-add, or innovative sectors.
The documents state explicitly that the electronics and IT sector accounts for 31.7% of the gross rental income.
Then nearly half of the total rental income is directly dependent on manufacturing supply chains.
I'm going to go to the next slide.
We will cover asset enhancement and rental reversions.
Yes. The Asset Enhancement Initiative is located at the 84 Boon King Road property.
The physical asset is undergoing a 2.6 million Singapore dollar conversion.
The building is being converted from a single-tenant facility into a multi-tenant facility.
The targeted completion date for this construction is the end of 2026.
The documents state the space is currently approximately 40% pre-committed to new tenants.
We also have the reported rental reversions for the period. A rental reversion measures the percentage change in rent when a lease is renewed compared to the previous contract.
Right. The Singapore portfolio achieved a positive rental reversion of 2.6%.
The Japan portfolio recorded a rental reversion of exactly 0.0%.
The filings specifically note the Toyo MK Fuso lease renewal in Japan. This renewal involved 36,800 square feet of space.
And the new contract was signed at the exact same rental rate as the previous contract. The document states the final net lettable area of the converted building will be approximately 99,000 square feet.
We have completed the review of the documents. I will provide a purely factual summary of this review.
Okay.
The management base fee is set at the 0.50% maximum limit of its peer range, prioritizing total asset scale. The initial net property income for the reporting period fell 4.3% short of the IPO forecasts, caused directly by currency exchange rate fluctuations and a delay in a lease commencement. The property portfolio contains explicit concentration in single tenants, with the top 5 tenants providing 30.2% of the net property income. It also contains explicit sector concentration, with the electronics and IT sector providing 31.7% of the gross rental income.
And as we stated, checking initial performance updates against the original IPO forecasts is a standard procedure for verifying the literal execution capabilities of the management team.
I think we have covered the material extensively.